Hey, real estate rock stars, welcome to the whole enchilada of real estate investing, the only podcast that serves up the full feast of street smart strategies to build wealth and take control of your financial future. I'm Lou Brown, and I've been in the real estate game since 1976, so I've learned how to make the whole plate worth it. Each week, I'll be dishing out creative financing hacks and proven systems that help investors build multi-million-dollar businesses. No fluff, just the good stuff straight from the source. Ready to dig in and start making deals? Let's get to it. So welcome everyone to the whole enchilada of real estate investing. I am your host, Lou Brown, been buying, selling, and holding real estate now for over 40 years, and I'm so excited today that we have Zach on board that is going to share with us some amazing things about what he does in his business and some unique things that I think you're going to enjoy and take away from what we're talking about today. Zach Gray, tell us a little bit about yourself and introduce yourself.
Yeah, thank you so much, Lou, for having me on today. I hope I can bring some value to all of your listeners and share some of my personal experiences along my journey in becoming a full-time real estate investor and talk a little bit about not only, some of the glorious elements of reaching that threshold, but also some of the bumps along the way that were a byproduct of getting to this point. So I think
Amen.
I think it's
You are so
easy to
right.
I
Go
think
ahead.
it's easy to I think it's easy to step in the limelight and talk about all the good things, but I think it's also important to recognize some of the challenges that you face along the way as well.
Yeah, it is to be expected that definitely things don't work out as you expect. And it's the ability to navigate those things. It's the ability to get with it and stick with it. One of my favorite sayings, causing behavior, causing you to be in a different realm when things like that happen, and pushing through it, causing it to occur is a great thing. I'm joining you today from beautiful Charleston, South Carolina, where we have had a wonderful platinum mastermind group from all over the country that have been sharing and learning about real estate. So I would love to know where you're located.
Nice. Yeah, I'm based out of the second biggest metro in Massachusetts. That's that is Worcester.
Worcester.
So, yep,
Yes.
about 45 minutes from Boston. And that is where my business partner and I are. We have an office based out of there. We also own a significant amount of property about in a 1 hour radius surrounding Worcester and Worcester County.
How about
And
that?
and I would say that we've managed to go from about 12 units jointly, so about 5 for me and 7 for him when we first started partnering. We've managed to get from there to 450 units in about 4 years.
Fantastic. That is so awesome. Definitely love Massachusetts. I used to work many decades ago with a company from West Warren, Massachusetts. And so I'm familiar with your area actually. And wow, there's the law of supply and demand is definitely strong in your area. There's a lot of demand and not as much supply, which makes it wonderful when you are a real estate investor and you hold assets. So it sounds like you are in the buying and holding world. Is that right?
Yeah, so a vast majority of what we do is buy and hold value add multifamily. We're habitually looking for properties anywhere from, a 2 to 4 unit that will likely do a flip on. Anything that's 5 units or more will normally retain. In regards to what our buy box is, we're normally trying to buy B and C class assets that are underperforming in regards to gross revenue, and they habitually have some semblance of deferred maintenance all the way up to deep value add, meaning lack of certificate of occupancy or gutted units or fire damage or floods, things like that. And I would say that with that being said, I think that we habitually try to have this year, our goals are to have roughly about 7 to 10 flips going on at a time. We have an individual project manager that oversees each flip. And then we are looking to acquire roughly 250 plus units this year.
Wow, that is intense. So tell us, Zach, how do you typically find your deals?
A vast majority of so a vast majority of our deal flow comes through our inner circle and network. My partner runs the biggest real estate investor networking event in Worcester, Massachusetts, and he and I are both investor focused agents for a brokerage that solely deals with buying and selling investment property. And he is a team lead, and he has, I think, a total of 7 to 10 agents that are work underneath him. With that having been said, we have a subscription to CoStar. We then allow our entire investor focused team to utilize CoStar as a means of cold calling. And then any deals that people on his team derive from cold calling off of CoStar. For those of you who don't know, CoStar is basically commercial multifamily property, and they have individuals, the owners' names, contact information, email, phone number, everything you need. And any of the agents that are on his team that derive an appointment from utilizing CoStar, we allow them to be the broker on the transaction. So it's hyper incentivizing his team to get larger size transactions under their belt. And it also makes it so that we have a lead flow coming from that. In addition to that, one of the things that we pride ourselves on as a partnership is that we provide equity to anybody who brings us a deal. So, regardless of monetary contributions or regardless of experience or track record. So, we basically will, if anybody brings us a deal, we'll plug them into our infrastructure, implement our systems, and then we will teach them or walk them through how to run the project with weekly meetings. And then they'll go on site, provide updates, pictures, communicate with contractors. So it's an opportunity for them to have like a foolproof, bound for success outcome on a deal that they find. They get equity in the deal without having to bring any money. And it also is a phenomenal learning opportunity for them. And this is something that we do routinely. And I think that one of the things that I learned along the way is that there comes a pivotal moment in any business endeavor where you have to shift your mindset from hoarding resources to maximizing efficiency to preserving effort and energy. And then you have to shift to relying on other people. And that shift, when you start relying on other people, you have to complete 180 your mindset to going from this very selfish mindset that's allowed for you to rise through the ranks to now being extremely selfless, and then being able to implement the EOS structure, which is the entrepreneurial operating system, which is essentially creating the KPIs, creating key performance indicators that move the needle for you and your company, and then determining what those are, and then working backwards through all the people that you rely on to then create incentive structures for them to achieve those outcomes. So then what ends up happening is every person on your team, they are compensated. There is no bound to their compensation based off of their efficiency and their productivity. So now what you have is a you almost have an organism that functions synergistically, and everybody has incentives to perform at a perpetually higher level based off how much effort, intensity, and work ethic they want to put into what it is that they're responsible for. And I think that shifting the mindset to implement those tools is instrumental in retaining talent. It's instrumental into building a team, and it's instrumental in really deriving deal flow and creating a system where, frankly, like we have more deals than we can actually execute.
That is so beautiful. Let's slow down for just a second. I love the concept of being able to compensate people along the way. And it sounds like what you're doing is equity. In other words, you're not writing a check, but they are participating in the outcome of the deal. Is that correct?
Yeah, and so more often than not, if somebody brings us a deal, we will provide them equity and they'll normally be responsible for being a participant in the boots on ground fact side of things. We do have a 19-person staff in which the people who work for us, they do work for a check, they do work for an hourly wage, and that as they exemplify proficiency in their role, we aim to promote from within, but also each person not only has an hourly wage, but they also have commission structures tied to their performance. And then for our more senior employees, they essentially have there's an opportunity as time prevails for them to receive equity in all of our deals, not just deals that they bring to us per se.
Wonderful, wonderful. Obviously, with the number of units that you're adding, you have a funding aspect of what you do. How do you typically raise your funds for your deals?
Yeah, so we create a CRM that manages all of our relationships with contacts. And what we do is every time that we go to networking events, we compile people's emails, add them to our mailing list. We also, every time we post on social media, we add a link for them to subscribe to our mailing list. And then we also we also have we Andrew, so my business partner and I, we guest speak at a lot of local meetups. We also guest speak on podcasts like this. And in those are all avenues to create social media, podcasts, guest speaking roles, networking events. It's all opportunities for you to get people to follow along the work that you're doing and the projects that you're participating in. And I think that as time goes along, we continuously post about the end results on the deals that we're performing. And I think that our return profiles far exceed the norm of the alternatives in the marketplace. And so I think that we have a pretty profound following. And I think that there are some ways in which we structure our return profile for investors that make investing with us more lucrative than investing with other syndicators that have like offerings. And I'm happy to talk about that.
Oh,
But
I'd love to hear that. Yeah,
yeah,
because that's one of the things, of course, people love rocking chair money, right? If they can put their money to work because of energized guys like you and organized guys like you. And I love that you mentioned the EOS and the traction process because we do that as well. And it's something that does help to stay organized and move the business forward. It causes behavior. So definitely it's something I think that would be very attractive to people. The second thing I loved about what you shared is that you're really revealing to folks what's going on and they can follow along, kind of eavesdrop on your business and make a decision maybe later. Some people make quick decisions, some people make slow decisions. And so when they can actually follow along, I think that's a great model.
yeah, and I couldn't agree more with you. And I think that you hit the nail on the head. And I think one of the things that we recognized very early on in growing our company is that we realized some of the shortcomings of working with other syndication groups and what we wanted to see better, that we wanted to be better. And so I think the areas that I really honed in on is that I think that investor communication is one of the variables that is extremely underwhelming with most groups. And I think to that point, what we stick to as a non negotiable is we send out a monthly newsletter that provides updates on every single project that we are doing. This newsletter encompasses who we are, it encompasses descriptions of every person who works on our team and what they do. It encompasses our deal structure and for people who are novice and maybe interested in investing with us. It goes over all the deals that we have that are in acquisition mode. We have all the deals that are in progress. And then we have all deals that have been closed out in the last year and their measurable performance. It also has our market. We have market articles and data that is included to show what the areas that we are buying in, some information. It also includes investor tips. And then we normally tag a podcast that Andrew and I appeared on for people to have the ability to listen to us speak about this industry and share our knowledge basis. And I think that this newsletter tends to be on average anywhere from 30 to 35 pages on average.
Wow.
So
Wow.
I think
That is detailed. That's
yeah.
awesome.
And so
And really,
we do that
yeah, I
every single month.
agree with you that a lot of communications are very quiet when it comes to investments. And of course, people do wonder. They wonder, is my money working? Am I in trouble? Am I losing? The economy is always in turmoil. There's always things happening, and people do get concerned. So I love the communication aspect of that. Now, talk to me about the return aspect. What kind of return can someone expect?
Yeah. What our buying criteria is. So, first off, I think it's important to note what is your money going towards when you contribute the funds? And I think that it's important to note that in pretty much across every project that we buy, we are habitually raising our ideal deal structure is we are raising 25% down. We are asking for a closing cost credit to cover all of our closing costs. We are stockpiling 6 months of principal, interest, taxes, and in insurance into an operating account. And we are habitually getting anywhere from 75 to 100% of construction funding from the bank. And
Wow.
so in that sort of model, we derive how much cash we need in order to execute that. And we ensure that once the property is stabilized, the returns, the property will yield at a minimum a 10% cash on cash. And we will have the ability within 12 to 18 months from acquisition to be able to refinance out 50 to 100% of investor capital.
Okay. Now, so the investor that helps you raise that down payment money and that 6 months, and then separately you're borrowing the rehab money, so that's not really coming from an investor. But that investor can expect a 10% cash on cash return. Now, what about equity? Does the investor also participate in the equity?
Yes. So the way that it works is they get 50% of all upside. And so now I think why this is important is that a lot of syndication groups offer a higher split in terms of equity. However, I think one of the things that we do that's discontinuous from other groups and makes us more desirable is that when we refinance the property, the refinance proceeds are not split 50-50. The refinance proceeds go 100% to the investor until the investor is made whole. And why I think this is so instrumental is that in the event, let's say hypothetically, in the event that you were investing with another group than us, if their model was a 50-50 split, when they go to refinance, if you go to refinance with them versus refinance with us, you're going to get half the amount of money back from them as you would with us because you're getting the total refinance amount. Whereas we are not taking a dollar until you've received all your capital back. Now, additionally, so now if you're getting double the amount of money back with us as a peer who's running the same model, I think the other important piece that's being missed here is that we are executing our stabilization plan within 12 to 18 months, whereas a lot of peers are 24 to 36.
Ah,
So I think that now we're operating at twice the velocity and we're providing double the amount back on refi. So in reality, why this is so impactful is that you're really getting 4x the velocity of your capital because it's coming back to you more quickly. And then the last pivotal piece to note is that once you've received all of your capital back, you continue to retain the same equity position in that deal in perpetuity. So you continue to own the equity in that property indefinitely until there were a liquidation, right? You continue to benefit from tax benefits. You continue to get principal pay down. You continue to get half the cash flow. You continue to get half the appreciation of that property forever after you've gotten all your money back. And now if you've gotten all your money back, you can now redeploy it into another opportunity. And if you were invested with a peer who's running the same model, you're going to be able to buy into 4 deals with us in the same time frame in which you would be able to buy 1 deal with the peer.
Interesting. Boy, that's powerful. That's unique. I agree with you. That is something that you've taken the toy apart and looked at all the working parts and also the incentives for the investor to participate and continue to invest in with you and long term. And the model of getting the money back is good because, of course, people's situations change, but also their concerns change. And that does open the door for them to have an out, so to speak, of continuing to invest or not, which is some of the concern when people are getting into situations where their money's going to be tied up for an extended period of time. So I like that model. Now, wanted to ask again about location. I know you're in the Worcester area. Is that your main focus or do you invest anyplace else?
Yeah, we invest predominantly in an hour radius of Worcester. Anything from Worcester County all the way down to we'll do anything in Rhode Island. We do Northeast Connecticut and we'll do Southern New Hampshire. And we will at time to time venture in to do stuff in the Boston area, but returns don't the return profiles in those markets don't really meet our investing strategy. So oftentimes when we're doing something in the Boston area, it would be more like a flip option. With that having been said, I know that I gave a very long-winded roundabout answer to the return profile question, but I think that a much more direct, abridged comment is that habitually investors are receiving all of their capital back within the first 3 years of ownership. So if you just broke that down in regards to an average annual rate of return, if you're getting 100% of your capital back over a 3-year period, you're normally looking at somewhere between, at a minimum, a 25% rate of return up to a 33% rate of return on average for a 3-year period. Once your capital has been returned to you, we're buy and hold investors, so we're not really looking to liquidate the properties that we stabilize. You do have technically trapped equity in that property, but I think that the way that we view it is more through the mindset of what is the return on the capital that you originally put in. And so consistently recycling that capital and focusing on the velocity of that capital is our primary focus. I do think that if you were to calculate it on like an IRR model, right? If everyone knows that IRR is directly correspondent to disposition, right?
Mm-hmm.
The faster I dispo a property, the higher the IRR. So we don't really use IRR as like a measuring tool to surrounding return profiles. We try
Because
to
your plan is to keep it, right? Your plan is to keep it long term, not really one of these models where you're just flipping out of the property after you've stabilized the property. Heck, why would you give away the goose that's laying the golden eggs, right? The thing
exactly.
is making money. Why don't we keep the thing that's making money? You're singing to me, baby. That's a good thing.
And I think that like our investors like have instead of being like really pigeonholed to IRR as like a singular measuring stick, I think that we focus on once your capital is out of the deal, right? This like phantom equity that you've created, there's market fluctuations all the time, right? So like market pricing can go up, can go down, like calculating the amount of equity left in the deal and using it as like a tool to create return profiles, I think is a little short-sighted. I think that the way to really look at it is like, I got all my original capital back. I now have a free revenue stream. Massachusetts on average appreciates 5% per year. So even if you're vested at 25% equity in the deal upon a cash out refinance, of 5% on the total, let's do 5% on the total on a 25% equity position, right? That's still a 25% return, right? So let's not be fooled here that like the average appreciation is still 25% on your capital per year on, and that's over like an 80-year run horizon on average. But that's beside the point. The point that is most important to note is that once you've gotten your capital back and this revenue stream exists in forever, right? That property is yielding you cash flow monthly. That property is going to spit out refinance proceeds every 2 to 3 years, right? That's just an evergreen fruit tree that it continues to bear fruit for you forever. And you get to take that same capital that you had, that we gave back to you, and you get to go get another one. And let's do that over a 10, 12, 15-year horizon. And then let's see where you're at.
I love how you're thinking, man. You are definitely dialed in. And I love the fact that there's some synergy between what I teach and what you do. And it's a really powerful thing because we have profit centers. And when we're working with our properties that we hold long term, which is one of the things that I teach, is when you get that customer needs certain things and we sell those things to them, we provide those things to them. So we have 25 profit centers over and above what a normal landlord earns. So we're able to bring a lot of money to the bottom line just by providing these additional revenue streams in what we do and how we do it. And one of them is that all of our folks that are living in our multifamily and single family properties at the rent level, we give them what we call the path to home ownership, where we help deserving families end up with home ownership regardless of credit or financial background. And so we're giving them a hope, a dream, a vision for their future by actually putting them into a different mindset. We don't want to lose customers, obviously, on the multifamily properties. However, we know that we do lose customers because they do build up their credit, they build up their down payment, and they move and they go buy a property that we could have participated in all along the way. So a couple of things that I'll share with you there about your model that you can add to that, but definitely it is powerful what you're doing. I am very impressed, and I think you've got the tiger by the tail, so to speak, and congratulations on what you're doing. Now, you mentioned earlier about sometimes things don't always work out and you don't always have the perfect deal, which is welcome to real estate, right? We always going into a deal expecting certain things and it doesn't always work out that way. Tell us about some of those.
Yeah, sure. So we actually have one right now that we're about to list next week. And so we bought this property off of a good friend of ours who is a really prominent wholesaler. And this is a two-family property in Northeast Connecticut. We bought the property for 160,000. The property was pretty much gutted. It had a flood and due to burst pipes, and there was non-functioning heating systems. There was jerry-rigged electrical throughout. It was really dangerous. And so we bought this property, and when we went in there, our kind of analysis on it was that it was going to cost us roughly about $80,000 to do the work. And we are predominantly based out of Massachusetts. So we do have some contacts in Northeast Connecticut, and we utilize them to help us secure vendors for this project. But when we bid everything out, what we determined was that the cost was going to be more significant than we had originally underwrote. And I think this was a byproduct of us not realizing how bad the electrical was from inception. That was really one of the instrumental things. And then I think that we didn't realize also what the cost would entail to install two mini split units for heating.
Yeah,
Um,
I'm familiar.
in regard, yeah. So I think those were the two things that we underestimated. And so rather than panicking when we got into the position of, all right, here's what we got quoted out for everything, I think that I think we did two things. I think we looked at the existing business plan and we said, all right, what are the wants and then what are the needs? And then when we mapped out the needs, we saw that we were able to carry out the business plan, and we would probably finish about 10% or so over scope. So it was sustainable and we would still profit on the project. But
how many units?
I was a 2 unit.
2 unit. Okay.
So we're going to do a flip on it. And so we thought that we would originally we were banking on making 50,000 on the project. Our budget was going to come in 10% over what we thought. It was going to result in us making 40,000 on the project instead. And I think that we looked at it at the same time. One of the wants that we had was that we knew that we would garner a significantly higher price for having hardwood floors, for having mini splits versus baseboard heat. And so I think that we looked at it and said, all right, if we opt to go this more kind of cheap route, LVP flooring, electric baseboard, things of this nature, we can operate within scope, but the end outcome, is somewhat subjective here. Like, we project that we might be able to make 40 grand, but that's not a huge margin. And so things could get dicey here quick, and then you could really walk away with 15 to 20 grand, and you spent a lot of time on this.
Or nothing, as the case may be, because you don't know what you don't know.
Yeah. So then I think the important point to note is that when you run into these situations where, you deal with some scope creeps that kind of throw you for a loop, exploring all options. And so while we were exploring all options, we said, all right, here's the cheap route for the multifamily option. Here's the expensive route, and we probably will end up in a position where we won't make any money. But also, let's explore other alternatives. So we looked at other alternatives and we said, what's interesting is this same market, single family houses sell on average for 20% more per square foot. Interesting. So now, if I do go the single family route, I have to have one less electric panel, one less mini split, one less water heater. And you see where I'm going with this.
One less kitchen.
Yeah. And so now I'm looking at this and I'm like, wait, so thing's already gutted. It's a shell. Yeah. I'm like, if we just pimp this thing out and make it super pristine, we can still secure all the luxury finishes that we wanted. And we're able to now operate within the confines of what our original scope was. And it sells at a 20% premium to what our original exit valuation was.
Correct.
And so we went to the city and we were like, hey, if we want to convert this from a duplex to a single family, what do you think about that? And they were like, we would love that. Yes. And I was like, all right, sounds good to me. So we actually, in reality, ended up pivoting post-close, right? And completely altering our business plan. And we bought the property for $160. We are in it for $130. So $290 is our all-in cost. And we're about to list this property on Monday for $415.
Yeah, baby. Yeah, baby. I will tell you, Zach, I've done that multiple times, taking duplexes and making them into single family homes. I love it. And it gives you so much additional options. You've got these bonus rooms that used to be the kitchen, right? And the extra kitchen on the other side. And you've got multiple bathrooms because you've got the bathroom benefit from each side. So I love the model. I love the idea. And I love how you pulled the rabbit out of the hat and converted it from maybe a loser into a real winner. Congratulations on that. That's a plan. That's a man with a plan, y'all. And definitely, Zach, you have been so insightful today. You've given us some great information. How do people reach you?
Yeah, absolutely. The best way to reach me is via Instagram. My handle on Instagram is at the 1099 mindset.
At the 1099 mindset. I like it. And any other contact information or information you want to share?
Yeah, I would say my company's name is Freedom Management. Again, we're based out of Worcester, and We constantly have investing opportunities. I'd say you can also look at me up on Facebook. My name is Zach Gray, Zackgray. And we post frequently, me and my business partner, we post frequently about all the deals that we're doing. You can subscribe to our newsletter, follow along on some of the projects that we're doing, and hopefully there's an opportunity to collaborate in the future.
Yeah, baby. Great stuff, Zach. Thank you so much for joining the whole enchilada of real estate investing podcast today. And definitely, I know that you're going to be highly successful there in Massachusetts and in your future endeavors. So congratulations, and looking forward to talking to you soon.
Absolutely. Thank you so much for having me.
Yeah, baby. Take care. See you soon.
Bye.
Thanks for tuning in to the whole enchilada of real estate investing. I hope you're feeling ready to take your investing game to the next level. If you're serious about building wealth, you won't want to miss the Millionaire Jumpstart. It's a 3-day live event that's perfect for any level of investor. Whether you're just getting started or you're looking to scale, this can be one of the final steps of making real wealth happen. So, what are you waiting for? Enroll now at millionairejumpstart.com and get ready to make big moves in your real estate journey. I'm Lou Brown. Until next time, keep hustling, and remember, it's not about how much you make, it's about how smart you play the game.